Prepare yourself. We are anticipating a jumbo rate cut in October.
Economists say that this cut today in the U.S. will spur the Bank of Canada on to make further cuts to its interest rate.
Because so much has happened in the last week, we'll be going over some facts and data that's pointing towards a 50 basis point rate cut at the end of October. So make sure you stay tuned. Now, if you want to talk about what your plans are for real estate, given what has transpired in the last week with like all these big announcements, you could do so by booking a call with me using the link that's on the screen right here, or you can also click on the link that's in the description below. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and a question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen. If you're enjoying the content I'm putting out there, do me a favor and like and subscribe. And on this reaction video, we'll be talking about CBC's latest about that video, talk about, are we anticipating a jumbo rate hike? So I'm gonna roll the clips that are important for us.
Just a few months ago in June, pretty much every economist we spoke to expected the Bank of Canada would continue to cut interest rates, but the pace would be cautious and slow.
Realistically, we're talking two.
I'm going to note here, this is a June 5th component, right? So the big Federal Reserve rate cut was last week. This was in June, and we were just looking towards getting our first rate cut, right? So I was even saying, hey, maybe we get 2 or 3, and that's what everyone's anticipating, unless things get worse. Things have gotten worse.
We're 3 of these quarter percentage point rate cuts in 2024.
Our best guess is that it could take up to 2 years to ultimately get back down to around 3% or what the bank considers to be normal.
So where we end is still up in question right now, and that's kind of what I think the question that people aren't asking. Because if things do get worse, we can totally go way past the 3% and go like 2.5% or maybe even 2%. It just depends on the magnitude of how bad the economy really is.
We need growth to start picking up. We need job creation to start picking up.
But the plan was to take things slow because inflation still wasn't under control.
So at that time, we have to keep in mind inflation wasn't under control, but we just got the latest inflation numbers, and you can see over here that we're now below 2% of their target rate. And that's well below the 2 to 3%. So now that's one signal to say, hey, look, you have the go ahead, the green light to start cutting rates more aggressively.
Cutting rates risks driving inflation up. And according to the analysts we spoke to, there were concerns about cutting interest rates too fast and falling too far out of sync with the US.
A lot of people have argued that, and I've talked many times before, like, I don't think it was a huge concern because in previous pressers, Tiff Macklem came out actually on September after the second rate hike saying that there are limits of how much, Canada, it's being Canada, can diverge, but those limits have not become a constraint on the Canadian monetary policy. So even before the rate cut from the Federal Reserve, the US equivalent of Bank of Canada, happened, this wasn't even on his radar. But now that the Federal Reserve did cut, it just, again, gives them another green light to continue cutting, and hence why everyone's talking about this jumbo rate cut.
But this week, all of that changed.
Headline inflation cooled to 2% in August, returning to the Bank of Canada's target for the first time since 2021.
The Federal Reserve today delivering a jolt to the U.S. economy, a 0.5 percentage point cut to its benchmark rate.
So you can see in this chart here, Canada and US is more or less in sync, right? Because our economies are pretty tied to one another. We're significantly smaller, like we're, the size of California, that's even smaller than the US. So we're pretty insignificant. So we're kind of, taking cues from the US. But what a lot of people weren't expecting is that the Federal Reserve was going to cut the 50 basis point, which means that, again, like I was saying, it has a green light, but why are they cutting 50 basis point? Is it so bad? And if it's so bad, that means Canada's probably not that much better, and we should be expecting another jumbo rate cut, because you can see over here that we usually lead the pack with the green, right? So we kind of cut first. So that's why I'm saying there's 2 big announcements right now saying, hey, look, things aren't good. We're going to see more rate cuts. But just remember, rate cuts doesn't necessarily mean prices go up. We have to see what the rest of the economy looks like.
We know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level.
So the Federal Reserve, similar to Bank of Canada, every like 6 to 8 weeks, there is an announcement. Their next one is like the start of November, which is around the election time. So can we see another big rate cut then? We don't know. But just understand that Canada's next cut is at the end of October, and then we got one in December. So we could very much be following their path of a 50 basis point cut. And then depending on what they do in November, we may or may not follow in our last announcement of the year in December.
But the other reason the Bank of Canada might want to mirror the US rate cut is because of what that rate cut signals about the strength of the US economy, or the lack of it.
People don't cut rates because the economy is doing great. They cut rates generally because the economy needs a little bit of a boost.
And that's the important thing that I've been saying. Just because rates come down doesn't mean prices go up. Everyone's situation is going to be a little bit different. It just really depends on your employment. And as we're seeing unemployment climb high, if you're not going to be, having a steady paycheck, you're not going to be buying a home. And that trumps any rate cut, no matter what the rates are when you're buying something. So depending on the severity of the recession and how many people lose their jobs, it could very much have a detrimental effect on the real estate market, which basically means that if it's like a soft-ish landing, not too hard, it can probably have legs and bounce back faster than most people expect. But if it's really, really, really hard, anticipate things to get much worse.
Inflation is now down to 2%, but the bank seems increasingly worried that it might actually fall below that 2% target and push the economy into recession-like.
And that's exactly why we may see more jumbo rate cuts, because that is what the central banks are afraid of.
Last month, the unemployment rate shot up to 6.6%. That's up from under 5% 2 years ago. And estimates show that the GDP only grew about 0.5% in the third.
So when people aren't working, GDP doesn't grow as much, right? So I pulled up this history chart of unemployment rates, and I essentially highlighted the yellow ones where unemployment rate rise. So you can see here, this was the 90s where we had a real estate correction, the 2000s where we didn't have a real estate correction, the 2000 or late 2008 by the great financial crisis, we didn't really have kind of a real estate crash. Over here, we had a minor blip and then it kind of rose. And I'm not saying all of this not because there's a trend, but I'm just saying when unemployment rate kind of goes up, it goes up for a little bit before things revert back to normal. So us being at, say, 6.6 over here, right? I don't think this is the end of it. We're going to keep seeing this unemployment rate keep going up and up while the central banks continue cutting rates to incentivize a lot of the businesses to start hiring people again. And that's kind of how they're going to try to hit the soft landing. How soft that will be, that's TBD.
All of this has economists predicting the next few cuts could be big ones.
I do expect, instead of 25 basis point cuts at their next two meetings, which I have right here, October 23rd is the next meeting, and then December 11th, I expect to see 50 basis point cuts at both of those meetings. So lower by 100 basis points within the next, call it 3 months.
If that does happen, the variable will be lower than the current fixed right now, which will have a sizable impact on the market. But as I've been telling with a lot of clients, anticipate that demand to come back at the start of 2025. Now, in regards to the fix is generally forward looking anyway. So I foresee if we're going to get these jumbo rate cuts from the Bank of Canada, the fix could be coming down even more in the next few months.
If lowering mortgage rates causes some dramatic bounce back in the housing market, causing inflation to go back up, who knows how the bank will have to keep tweaking things in response. But for now, if you're looking to buy a home, if you hold a mortgage.
And this is kind of why I said a while ago that this is probably a decade of volatility and things could go zigzag up and down. No one has any idea, but the levers that, these central banks can pull are few, essentially just raising and dropping interest rates. And when the debt is so large, these levers that they can pull have an outsized impact, hence volatility on the up and volatility on the down. And we kind of saw that already in May 2023 when Silicon Valley Bank collapsed and our real estate market in Toronto kind of spurred up for a pretty significant amount, and then it came back down afterwards. So I would be prepared for volatility, and timing things right now will be incredibly difficult. All of these data points are, positive for the real estate market, but I don't think they're going to have an impact on it right now. Because like I've always been saying, the inventory is what drives kind of where the market goes right now. And right now we finally crested at 25,000 active listings. I'll put a chart over here. So the current days on market right now is about 44 in total for stuff to be sold, assuming it gets sold. So we have about, September until call it mid to end of October to see if this new wave of listing does get absorbed. And then that's going to dictate where we're going to go towards the end of the year and the start of new year. Because Inventory will always tail off at the end of the year. How much of that stuff comes back in January based on what the rates are at the time is going to dictate the momentum of the market in 2025. But currently right now, we're just like slightly better than last year, which was like a 20-year-ish low, give or take. So we're better, but not that much better, like 5-10%, give or take. Anyways, I hope this gives you an idea of what's happening in the real estate market. A lot of this stuff that I talked about today is going to have an impact on us in 4 to 6 months. It's a little bit too early, but this is just to give you the anticipation of what we're looking down and what a lot of people that are kind of buying and selling right now are thinking about. And if you do want to work with me and my team, you can do so by booking a call with me using the link that's on the screen right here, or you can click on the link that's in the description below. Until next time, your move, your future. See ya! Now that you're done watching this one, how about this one? Or this one? You know what? Just watch them both.